I read the ECB's Bitcoin hate paper, so you don't have to. This is Alex, your favorite crypto scientist from Vienna, and I went through this paper that the ECB published recently to tell you what the conclusions and the weird assumptions by the ECB are, and what they tell us investors actually to do. And you will be very surprised in the end that it's not what you might think. So like with every paper, let's start with the abstract. And they are quick overview for you. So they are saying that the promise of Nakamoto to give a better global payment system has not materialized. The focus has shifted from this payment to an investment asset, and it's only for speculations, and it's little effort relating to Bitcoin's economic function. It's only about the price movement, about gains. And most economists argue that the Bitcoin boom is a speculative bubble which will eventually burst. And in this paper, they analyze though, and this is interesting, the Bitcoin positive scenario in which the price continues to rise. And this is why I actually read this paper, because I thought it was very interesting. And it sounds promising, they say, but it's harmful for society. And I will also come to this in the end of the video, what they say is the harmful thing about society and what this implies for you or for us as people who have been holding Bitcoin or thinking of buying Bitcoin or more Bitcoin soon. And so the wealth effects of the consumption of the early Bitcoin holders, they can only be on the expense of the rest of the society. If the price rises for good, it will make latecomers poor. Basically, that's what they say. But let's look into the details. So, all right, guys, let's start with the boring part, with the introduction, where they talk about Nakamoto and that essentially it hasn't materialized. They say that after 16 years, the real Bitcoin payments, they are still slow, expensive, cumbersome. They are actually not existent, and it's not really in use for payments. They mention El Salvador as this example where they even declared it as a legal tender, and still it remained a failure, because they say, from quoting this paper from Paris and Obregon, that actually it's still not in use despite being a legal tender. And where it is in use is with this Chivo wallet. And the Chivo wallet, they say, it has its own central ledger. So essentially it's going against this ideology of decentralization. In the end, it's just another centralized system. And I mean, if this is correct, I haven't checked the facts here with El Salvador, then this is a point. I mean, not everything that they say is wrong. Actually, in the whole paper, they state a lot of things which are factually correct, but the vibe on how they interpret it is very negative, right? So here say the least harmful use is speculation and gambling. And but it's also used for terrorist funding, for narcotics trafficking, and money laundering. That's also from another paper. And this is very interesting, because we know that like it's known in science, but also in the crypto industry in general, from statistics that are publicly available, that most criminal organizations, most criminal usage of money transfer is still in cash, because cash is not trackable. Bitcoin is not anonymous, it's pseudonymous. So it means that if you know who processes a Bitcoin address, you can still verify who that is. So it's not as as of a black box as cash is. And and then they speak about the roller coaster ride with 1,000% gains, but also losses of 80%, and that many economists consider the fair value of Bitcoin to be zero, and therefore classify the market capitalization as a bubble. This is very famous Taleb, who is always saying that, and they also quote somebody else is called Avoca. So they pick the literature that confirms this view, and then they quote it here. So this is the first section, which is the rather boring for you as investor section, but the second section reviews the question of the fair value. Then we go to the third section, which is the macroeconomics of speculative increases on the asset prices, which is pretty interesting. And the last but not least, section 4, which is the redistributive effects of Bitcoin, which I promise you might like. So if you have been early to Bitcoin, if you think of investing today, the European Central Bank actually gives advice. They give financial advice on what to do. It's not me, but they give financial advice on what you can do to become wealthy. Then in the second part of section 1, they start with saying that what Nakamoto's original vision was and what he explained, and they say that it is based on, it starts from a misunderstanding. So from the start, it's a misunderstanding that Nakamoto thinks that you basically need these financial institutions to transfer money, but that's actually not true. In e-commerce, it works differently, and they argue that the TradFi system actually has solved this problem by themselves, and that Bitcoin is actually not needed anymore with the modern technology. That's what they basically say here. Then they talk about the fair value of Bitcoin, and they talk about most assets generating cash flow. They compare it again with real estate, with bonds, and with shares. They say that those pay interests and that Bitcoin doesn't do anything of this. And it cannot, I think here it's good said, it says, as been argued elsewhere, Bitcoin lacks the traits of established financial assets. It does not generate any cash flow, interest, or dividends. It cannot be used productively. And there they also draw the analogy to gold and say that actually, hey, it's not even as good as gold because it's not a commodity that is usable in production. By consequence, most established ways of calculating the fair value of an assets fail when applied to Bitcoin. And that's actually correct. The whole world has such a difficulty in saying what the value or the price of Bitcoin should be at a certain point in time, because there is no really comparable asset. All the traditional assets we know, they function differently, and we cannot apply the same fundamental analysis to determine this value of this new asset. And they say that the discounted cash flow doesn't work because Bitcoin's lack of income streams or dividends. And they go on that everything here is kind of fugazi to Bitcoin. Then they even take the stock to flow model in consideration, which gained popularity. But they say that the weakness, it has not been published in any scientific journal, and it has not undergone any peer review, and therefore, it's not good. Also, it hasn't predicted the latest movements of Bitcoin. They say during the last bear market, or the most recent first part of this bull market, that Bitcoin was actually not accurately predicted by it. Bitcoin as a pure investment detached from any use case. And here it gets interesting because they quote also Larry Fink, who says that he believes it goes up if the world is frightened, if the people have fearful geopolitical risks. They are fearful of their own risks. It's no different than what gold represents over thousands of years. It's an asset class that protects you. And then he also says, and this is also quoting Larry Fink, he says that unlike gold, where we manufacture new gold, we are almost at the ceiling of the amount of Bitcoin that can be created ever. And it's a very, very good store of wealth, he says. And this is from a paper by Hoffman, also very new paper here. So they go on with quoting Mike Novogratz saying it will be larger than gold. They go on with Katie Wood and others that see huge increases for Bitcoin. And then they go on to say that this is not true, what several say about Bitcoin, because there are plenty of assets, countless assets on Earth with a limited or finite supply. And that's not wrong either, because there is land, for instance. Land is finite. We don't have unlimited land globally, for example. I think maybe they even mentioned land. I believe they did that. Including tangible items like German stamps from the 19th century, or a set of collectibles, or land. Here it says land. They say that scarcity is not a Bitcoin thing. Also, this is correct. They say rarity doesn't equal scarcity. Scarcity is a function of supply and demand. So only if something has demand, it's really scarce. Otherwise, it's only rare. And that's true as well. So many things here are true. And they say if the supply is fixed, the price becomes exclusively dependent on demand. And if the demand were to disappear, the price would be zero. And that's why they argue Bitcoin's price is zero if nobody wants it any longer, which is not the case. And I think this is also important to understand at this point, that Bitcoin is rather growing in demand. And yes, it is two things, two options. Either it's a big monetary revolution, or it will become the biggest Ponzi in history. Then they go on with the political debate. I will kind of overgo that now. They talk about political parties fighting for who can control it, who can kind of be the Bitcoiner. Is it Trump? Is it Harris? They talk about American politics, but also about legality and about the US having more and more crypto lobbyists. So they say that politicians are lobbying for crypto, or not politicians, that crypto is lobbying at the politicians. So crypto companies are trying to make it grow despite it having zero value. And then they go on with saying that despite all of this, Bitcoin and crypto doesn't play any major role in any of the party programs. And they focus here on the United States, the Democratic Party and the Republicans. But generally, they say it's politically not really of importance. Where it gets pretty interesting again is the chapter 3 with the macroeconomics of large asset price increases and the welfare on society, basically. So they say that they have case A, productivity increase without wealth effect, and no marketable wealth effect. So there is nothing to promote to say that asset prices like stocks go up. This is just a long-term productivity increase. So the wealth effect in green here, I think it says somewhere here, light green boxes, exactly, the productivity increase in the light green boxes. So productivity is increasing. That's great for the economy, they say, but it's not marketable. On the other hand, the productivity effect is there. And at the same time, the news about the technology also makes a wealth effect on the stock, for instance, of some innovators. So the asset pumps here in red, and the long-term effect is this. So the benefit in productivity through this innovation. Then we have the lagged effects. This is when there is some hype. For instance, we have a company that is building things and need years to complete it. And it's already in news coverage, and the stock price of this company is increasing massively, but it takes several years until it manifests that the innovation actually becomes helpful, can help here, right? Then we have wealth effect without productivity effect. And this is the Bitcoin scenario. They argue, they say that the most likely case for Bitcoin, it seems at the moment, is that it will go up only. And that means, as you see in red here, that the asset price goes up and up and up and up and up and up over all the years. Which looks like this. And figure 5 is the bubble. So it goes up and it goes down again. And in the last section, they focus on this case where the price of Bitcoin is just going up. Let's move to further down. This is all a lot of interesting quotes here. If you are interested in financial markets and risk assets in general. And now we come to my favorite section number 4, because it explains essentially that you, if you're an early Bitcoin holder, will be rich. And this is the message. The message is buy Bitcoin early as possible, and that you don't have enough Bitcoin today. This is not my financial advice, but it's what the union, the ECB, the Central Bank of Europe, says. They say Bitcoin wealth has, as any wealth, positive consumption effects on Bitcoin owners. As at the same time, since Bitcoin doesn't impact on the production potential of the economy, these positive consumption effects must be at the expense of some other usage of GDP. So they say essentially, those who have a lot of Bitcoin wealth, they are consuming on the expense of the latecomers, early birds and latecomers. This is what I would criticize here. First of all, that this study is classifying or categorizing in only 2 groups. We have early birds and we have latecomers, which is factually nonsense, because every day another person could get into Bitcoin, and it's a continuum. We have Satoshi at the very beginning. We have the early birds from 13, 14, 15, 16, 17, right? And we have those who got into Bitcoin 2 years ago, and we have those who get into Bitcoin today. And still a growth of the global population is not in Bitcoin. So they argue there are those who have Bitcoin and those who don't. And they say that the early birds transfer 2% of their Bitcoin every year in their simulation. Every year, 2% of their Bitcoin to those who do not have Bitcoin yet. And the Bitcoin value held by an early bird in the period T times 0, it's 10, and the latecomers have 0. And then they kind of give it from the early birds to the latecomers year by year. They also say that the real asset value held by early birds and latecomers is the same. So they say real asset value is 50, and it's also 50 for the latecomers. So they say they talk like the wealth of all assets was distributed equally at this point in time 0, and then only Bitcoin kind of shifts it. So it shifts it every year by this 2% from the early birds to the latecomers, which is, I mean, to be honest, this is a very, very simple simplicity, a lot of simplicity that does not work in reality. Sharing of real wealth. So it says that the early birds, they increase in real wealth over time, because in the beginning it's 50-50, and then it slightly goes towards those who own Bitcoin, because they can sell 2% of the Bitcoin yearly to those who don't have Bitcoin. Then we also say that total Bitcoin wealth, it starts from only Bitcoin holders having it. At the same time, the Bitcoin price keeps increasing because this is, as we know, the Bitcoin positive scenario. And then the latecomers have more and more Bitcoin as well. So it's kind of that both still rise, but more and more Bitcoin are sent over to the latecomers. Then, yeah, here is the same. The share of Bitcoin holdings at time 100% is with the early birds, which is basically, if we start today, everybody who owns Bitcoin, and this is the whole rest. So if you own Bitcoin today, the ECB says, in 36 years, you will still be owning 65 or 70% of it. And here they say that the Bitcoin early birds will be able to consume more in the future. And all of this says the conclusion that no productivity, no intrinsic value. It's only a shift of wealth from early bird investors to late investors. And I kind of remember that I've heard that before. What do you think about investing in risk stocks? Did you invest in Tesla early? I mean, you could sell it now and consume much more than before, and you sell it to those who buy for a much higher price now. Isn't it the same with all risk assets, regardless of them producing any dividend? Especially with risk stocks, it's questionable because they don't produce dividends, and maybe they will never do, right? So the whole study here is just telling you, buy Bitcoin as early as you can, best yesterday. I hope you enjoyed this video, and I wish you a wonderful rest of the day. Check also my other stuff. If you liked it, like down below, please. And also give a subscription to my channel. I wish you all the best. Your Alex.